Welcome back. Now, does Modigliani-Miller, what we did in the previous chapter, teach us that capital structure does not matter in a perfect capital market?
Please pause this video now, answer the question on a piece of paper, and then continue.
Yes, in a perfect capital market, capital structure does not matter. Does Modigliani and Miller also teach us that managers do not care about capital structure in a perfect capital market?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, managers may well care. For example, out of vanity. It only says that whatever they choose has no value consequences. So whatever they do isn't going to matter much. The CFO here has very little role to increase the value of the firm. Does Modigliani and Miller teach us that capital structure in the real world does not have value consequences?
Please pause this video now, answer the question on a piece of paper, and then continue.
No, it does matter in an imperfect capital market. The Modigliani-Miller theorem makes us understand what is necessary for capital structure to have value consequences. And the only way that we can accomplish this is if we violate the perfect capital market assumptions. Now, the evidence suggests the perfect capital markets is not far off from the truth for large publicly traded corporations. Not the case for smaller companies. So we studied capital structure in a case in which it made no difference, perfect capital markets, because we need to understand what it actually takes to make a difference. So if even capital structure does not matter, does anything matter? What about price earnings ratios? I mean, CEOs, CFOs are fixated by them. Do they matter?
Please pause this video now, answer the question on a piece of paper, and then continue.
Actually, none of these really matter in the sense they're all ephemeral. So there are things that go into the operations and the cash flows of what the firm produces, but they really don't create value. They do not matter. Think about an analogy of a thermometer. You care about temperature. You don't care about what the thermometer says. So the thermometer, the price earnings ratio, reflects the temperature. It reflects the cash flows of the firm. But by itself, it doesn't really matter. It's the cash flows that matter. Value matters. The net present value of your projects matter. This is it. Now, we can actually start nitpicking and argue about what happens if you choose the wrong projects, and that's perhaps pushing the perfect capital markets assumptions too far. For now, let's just leave it at that. Do debt and equity together really own the firm?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, in real life, there are also non-financial funding providers. This is like accounts payables. Plus, Uncle Sam has super control and super cash flow rights. You don't pay your taxes, you go to jail. Now, when we are going to speak for argument's sake, we're going to say that the claims holders are owning the firm, and we're going to make it simpler and just consider debt and equity for now. But you really have to keep in the back of your mind that it really extends to beyond just debt and equity. Do corporations have to pay income taxes?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, yes and no. Does your house pay income taxes? No. Does your house pay taxes? Well, you can view a corporation as a body, an institution that's paying taxes, and the tax is assessed in a way so it relates to that particular corporation. The same way that your property tax is not paid by your house. It is assessed based on the value of your house but it is you, the owner, who pays the taxes. Now, this has something to do with how foreign holders are taxed on a personal income tax level. And to this extent, it actually matters a little bit whether it's taxed at the corporate level or at the personal level. But for the most part, don't think about as big bad corporations, let them pay the tax so I don't have to pay the tax. It's actually you have to pay the tax. Even if you don't have a lot of income and you don't have a lot of holdings and you don't have a large brokerage account, very often what you get in your pension is tied to the value of the stocks that your underlying pension provider holds. So this is you paying taxes. Whenever corporations are being taxed, it is us, the final consumers, that are being taxed. Do investors care about before tax or after tax income? So, for example, if you get $200 in income and I tell you it's taxed at 50%, or I tell you you can get $100 and it's not taxed at all, does it make a difference to you?
Please pause this video now, answer the question on a piece of paper, and then continue.
Hopefully not. Investors care about after-tax income. They compare this to their after-tax opportunity cost of capital. So in this particular case, it doesn't matter at all. Now, which form of financing is preferable if the company that you own has its debt and equity treated symmetrically? That is, whenever the company pays $10 to its creditors or $10 to its shareholders, there is exactly a like treatment. Uncle Sam gets the same, say, $3 in both cases. Shareholders and creditors have to pay equal taxes on receipts.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, in this case, we are still in the Modigliani-Miller world. It's irrelevant. As long as the penalty is the same on both debt and equity, it doesn't matter. We know that from the previous examples. However, what if I tell you that only equity is going to be taxed, not debt? So if I give the equity $10, Uncle Sam is going to take $3. But if I give the debt, the creditors, $10, they get to keep the entire $10. Before, when they were treated symmetrically, I know that it didn't matter how much debt or equity there was. Now, under this case, where they are not treated symmetrically, where only equity is taxed, what should be the optimal capital structure?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, under those circumstances, it's clearly better to finance with as much debt as possible. You want the minimal amount of equity so that the equity doesn't have to pay a lot of taxes. Taxes and the tax code change very often. Taxes are different across different types of income. Ordinary labor income is almost impossible to shelter from tax payments. Therefore, if you have a choice, that's not what you want to get. Fortunately, we don't need to talk much about this because this is a finance class, and we're really interested in the other three categories: interest income, dividend payments, and capital gains. Now, interest payments are very, very hard to shelter too. So for the most part, they are taxed very badly from your perspective as a recipient of interest income. Dividend payments are also hard to shelter, but it turns out if a company has already taxed some of its earnings, you actually get a credit. You get a credit that the tax, the IRS carries through and gives you credit for, so you have to pay less in taxes. So dividend payments are better than interest income, but they aren't perfect. The best version for you is capital gains. They are very lowly taxed. First, they have a lower rate. They have rates typically between 20 and 30%, versus dividend and interest incomes have rate between 30 and 45%. This is taking into account state taxes as well. And in addition, it is only taxed when you actually realize them. So if you don't realize your capital gains for decades, it will never be taxed during those decades. And at the moment, the estate tax says that if you have less than $10, $15 million, you can actually pass that on to your heirs. Your heirs will get the money. The capital gains basis as which they are assumed to have bought it resets, and on every capital gain that was made before then, therefore, would never be due any taxes paid whatsoever. Most of these rules also apply to corporations. Now, on the recipient side, there are some endowments, churches, charities, not-for-profits that are income tax exempt. So the Mormon Church, the United Way, Harvard University, when they hold bonds, they get the full interest. They never have to pay any taxes on this. If you have a defined contribution plan, 401k usually, that also is partly income tax exempt. That is, you usually don't pay income when you put money into your 401k, but when you take it out, and many investors at that time are in a tax bracket that is not as high as when they were during their peak earnings years. Now, that's not guaranteed. It could be that in the future, it's actually going to go up in terms of income taxes that will have to be paid. Of course, there's also many foreign holders that are mostly US income tax exempt. So when the Saudi royal family holds US Treasury bond, they can keep the entire interest payments. Our Internal Revenue Service sees nothing. If I buy a US Treasury bond, I have to pay 45% of my interest income back to the US immediately. The Saudi royal family, the Chinese princelings, the Russian oligarchs, foreign dictators, a variety of complex foreign vehicles by US corporations and billionaires, they're all tax exempt. I'm not, you are not. Now, some firms with net operating losses also have almost no corporate income tax obligations, but that is fairly rare and they usually can be carried forward, so they still have value for other things as well. There's also other firms that enjoy preferred income tax and other treatment, and Congress passes new corporate exemptions, shelters, pork, every other year. Some of them are targeted just at single companies that are in the senator's state. Whatever, we can't help it. This is just how Washington operates. And then there's many large tech companies that either pay zero or top rates. They are set up in a way so that their main corporations sit in Ireland, and the way this all works out with all the tax rules, they may end up paying nothing. Now, we may say, well, in this case, maybe we want to tax them brutally and go after them. But it's not clear that it's in our interest, because a lot of these large tech companies also do a lot of business outside the United States. And if they then decide to leave the United States altogether, the golden goose will be gone. In that case, there's nothing to pluck anymore. So for now, we're going to assume that corporations can shelter, that is, reduce some of their corporate income tax if they issue debt. And we're going to cover this in the next video. In real life, the IRS sometimes and Congress sometimes may not play along. So at some point they realize that they're being taken too much advantage of, and then they try and send their lawyers after you and put you into prison. Many times, however, that's very hard for them to do. There's also other debt advantages and disadvantages that we're going to talk about in subsequent slides. And of course, then there's another aspect to consider here. So if you finance a lot of your company through debt, you as an entrepreneur hold most of the rest of the value in a very thin equity slice. That very thin equity slice is incredibly risky. Do you really want to have all your wealth exposed to bankruptcy in a very risky security? Not clear. So, in private firms with too much debt, the equity holder may be poorly diversified, dislike owning equity, and in that case, may not go for as much debt. This is all a good model sketch. It is not perfectly accurate. That's it for this video for the basic effects of the corporate income tax. So in the next video, we look at the details, how firms are actually dealing with these effects. It turns out this is one of the rare examples in which an imperfect markets model has formulas to recommend. In fact, it's the only example that I really know. These formulas are called adjusted present value and the weighted average cost of capital, now with taxes. They are also in very wide use. Every corporation is using them. So, see you soon. Bis bald.
What's the difference between a tax and a fine?
Tell me.
A fine is a tax for doing wrong. A tax is a fine for doing well.
Have you ever done well?
Yeah, very well. I've been telling all these great jokes at the end of videos.
They only warrant a fine.